thank you for joining us here at Seaford and Brew for our quarterly bank performance briefing. And for this quarter, we're going to review over the performance of our community bank benchmark group. And those are banks that have assets between $100 million and $5 billion. So overall, when we're going through our analytics, we like to slice this group up into 3 subgroups. And those include the subchapter S institutions, stock institutions, and then that mutual peer group. Overall, when we're looking at the performance on the average return on average assets, we saw that subchapter S group get up to 1.49%, very strong in the first quarter. We saw the stock group get up to 1.09%. And then that mutual institution up to 67 basis points. And collectively, if we look at them as one group, we saw the average return on average assets get up to 1.19 from where it was in the fourth quarter at 1.04. So we had a significant uptick in that level of return on average assets quarter over quarter, and even more so when we look year over year. But let's jump down to the primary driver of that return on average assets, and that's the net interest margin. And overall, we've seen the net interest margin come down year over year, where it was 3.71 back in the first quarter of 2020, all the way down to where we are today at 3.37. And that's coming down from the fourth quarter at 3.43. So we continue to see net interest margin move down. And our expectation is as we move throughout 2021, we're going to continue to see this margin compression happen. And when sometimes we might see the overall net interest margin pick up a little bit, and a lot of that could be due to the realization of those premiums from those forgiven PPP loans. But on the core net interest margin, we anticipate to continue to decline over the course of the next year. And the reason for that is, overall, the cost of funds has moved down tremendously year over year, down to 37 basis points. We're getting down to historic lows. And the question is, how low can we go with this cost of funds? Can we get much lower than 37 basis points? As an industry, I know bank to bank we can work down there, but as an industry, we're getting to the floor here. Whereas when we look at the yield on earning assets, we know that continues to decline, and as those assets roll off the balance sheet and have to be reinvested, they are continuing to be reinvested in lower yields. And while the long end of the curve has come up, since the beginning of the year, we're still at low levels when we look out throughout history. So we have this continual reduction in that yield on earning assets. And since the cost of funds is primarily at its floor, we're going to continue to see that net interest margin get squeezed. When we look at net overhead, and if you recall, this is an efficiency ratio. It measures the difference between non-interest expense and non-interest income. We like to see this below 2%, and historically we would say that anything below 175 would be a very efficient institution. And look where we are today. We are here at 171 across the industry. So we've seen these numbers really improve throughout the past year. And the question is, will these continue to stick? Part of it is due to the overall level of non-interest income due to the high level of loan sales, loan origination and sales, that bolstering that non-interest income and then lowering down the overall level of net overhead when we look at it collectively. But we continue to see improvements in net overhead, and that is good. The question is this going to be sustained? When we look at its components individually, the overall level of non-interest expense has continued to come down to 2.39% from where it was last year at this time at 2.76. That's a tremendous improvement that we're seeing in that level of non-interest expense. That, for portion of this, is due to the overall level of assets that we've seen come onto the balance sheet. We haven't had to ramp up in terms of our employees in order to catch up with that demand, because a lot of that's just deposits rolling into those investment portfolios since the loan pipelines have been fairly tight. So we're getting that benefit of the higher level of the denominator here that's helping us improve in that overall level of non-interest expense to average assets. Now we see the overall non-interest income to average assets is up from 54 basis points in the first quarter of 2020 to 57 basis points in 21, off slightly from where we were last quarter at just 58 basis points. So we're down just 1 basis point, but continue to see a level of improvement in that non-interest income. When we look at the credit risk aspect and we look at the non-current loans, we continue to see improvements here. Look where we are as an industry, down to just 44 basis points with non-current loans to total loan ratio. That's a tremendous improvement. Last year at this time, we were worried that this was going to get out of hand, but with all the stimulus that has gone through and the PPP loan program, that has helped stave off the credit risk that we thought we were going to have that increased throughout 2020 because of the pandemic, but that has not been realized. When we look at the equity to asset ratio as an industry, we can see it has come down year over year from where we were back in first quarter of 2020 at 11.12% down to where we are today at 10%. And a lot of this is due to the overall level that assets increasing at a much faster pace than we saw the equity increase. And then between the fourth quarter and the first quarter, we saw yields increase, which now we're seeing the impact of that on the investment portfolios. And when that happens, we have the portfolios become devalued, and therefore the overall level of equity is come down, because you have to realize that overall level of decline in the equity number. So that's a portion of why we've seen over the last quarter the equity asset ratio decline from 10.45 to 10%. And we can see this because the leverage ratio, which then adds back that overall level of decline in value, the unrealized decline in value of the investment portfolio, we saw that remain fairly stable quarter over quarter from 9.92 down to a 9.86. So we've seen that stabilize, but right now we're much lower than where we were last year at this time at that 10.75 because of the overall growth that we've seen in assets. And then the risk-based capital ratio continues to increase. We're up to 5.65. A portion of this is due to the fact that a lot of the assets that we have on the books now are remaining in very riskless or low-risk assets, and therefore bolstering their risk-based capital ratio. Plus the PPP loans that are on the balance sheets are at 0% risk rate, So that is weighing in here as well. So we're continuing to see this increase in the overall level of risk-based capital ratio. This is the total risk-based capital, up to 1565. Collectively, when we look at risk with the S&B Total Risk Index, we've seen an increase year over year. Quarter over quarter kind of starts to stabilize a little bit as we move through 2021. If we do not have any hiccups in the credit area, I would anticipate the number to come down slightly, but I do still think that there is some economic risk that's going to keep this elevated, and that margin pressure that we're having is also going to impact that earnings at risk category in the collective total risk index, and that's going to keep the overall level of risk up closer to that 50 index mark. So that's what we have for you today. We hope you enjoyed it. We look forward to seeing you in future webcasts. Have a great day, everyone.